I yield now to the Vice Chair of the Subcommittee, gentleman from Arizona.
Mr. Chairman, fellow members, witnesses, first off, in my opening remarks, I hope I didn't cause a little bit of fussing when I complained that the administration hadn't met its obligation. Being a freshman member, I've actually really been killing myself to read everything I get my hands on, Mr. Chairman. And with that, I was trying to be fair-minded on read stuff that was coming from all directions, and apparently I annoyed the ranking member with my fairness. Mr. Chairman, Mr. Pollack, I absolutely love this. It's having now read binder after binder after binder, one of the best white papers I've read so far. But one of your premises in there is that Fannie Mae and Freddie Mac distort the true price of risk. Am I fair in that assumption, or in that interpretation, or what I'm reading out of that?
That is exactly right. It's what we say, and I think it's quite indubitably the case. Mr. Chairman, could I recommend that the white paper that the Congressman refers to be entered in the record? That's all right.
Does the Vice Chair wish to enter it in the record?
Mr. Chairman, I would actually be elated. There's actually some terrific items
with no objections. They'll be entered in the record.
Thank you. Yeah. So when you push credit at an asset at a market, the credit flow gets capitalized into the prices in that market, and when you separate the risk of the providers of the funds by telling them they're guaranteed by the government, which I continue to think they really are, and so they don't suffer the results of their putting a large flow of money into, for example, a real estate market and driving up the prices. I think the only fair way to describe that is as a distortion of prices, and the result will always be unhappy.
And Mr. Chairman, I know I have very limited time and I have a handful of questions, so can I bounce on to the next one? This one is for all the committee members. In also reading your white paper, the belief that if we were to move to a much more true either private market or some sort of bifurcated, that we would also have to reach out and touch FHA and Ginnie Mae and those, so we didn't create a push on one side of the bubble to the other. Mr. Chairman, witnesses, is there an agreement that if we're going to approach a GSE government-insured market that we have to do something holistic? And let's start
I think we all
left
agree
end.
on that. I do.
And I agree absolutely with that, and I think we should keep in mind a lot of that is already happening. FHA is about half of new home buyers now, so it's already a considerable push of risk onto FHA as it is, but we need to avoid that further erosion of credit quality in FHA.
It would be very irresponsible to just look at Fannie and Freddie and not address all the components that impact housing in the United States.
I would agree that we need to, one of the reasons I would argue against a fully private market is because, in fact, it will push and create enormous pressure for us to keep FHA taking on risks that I think otherwise the private sector could be bearing if the government were standing behind with a limited liquidity backstop. So we are taking on more risk than we need to.
Mr. Chairman, you actually hit an issue I'm concerned that if we're going to do something, we need to be looking at everything together. Mr. Chairman, witnesses, do I have a prediction on the total loss in Fannie and Freddie? When we look back a decade from now, how much taxpayer money will have bled?
It's very hard to know, even if you're inside and poring over the numbers, but informed estimates range from $180 billion to $300 or $400 billion. Highly uncertain, of course.
I agree with Alex that it's highly uncertain, but the one thing I would say is that our actions now can very much affect the size of that obligation, both in how quickly we liquidate their portfolios. If we sell at fire sale prices, that actually reduces, potentially increases the amount of the losses. And similarly, the GSEs have an obligation to repay the taxpayers in effect in the form of these dividend payments. And if we sort of withdraw them from the market too quickly, their ability to continue to make those payments might be mitigated.
Okay, hold on for 1 second. Mr. Chairman, and Ms. Wartell?
Yes.
And forgive me. To that point, if I'm holding huge amounts of non-performing paper and I'm waiting for the market to come up to sell it, don't I perpetuate a 5-year real estate depression to last decade? Because when do you hit bottom? If prices move in expectation, and there's always an expectation of this huge overhang, And Mr. Chairman, Ms. Mortel, maybe it's because I come from, you know, the Phoenix area, where there's 50,000 foreclosures in process, and a year ago there were 50,000 foreclosures in process, and the year before 50,000. There is no change in expectation. I almost wish we would take our lumps, process through those. We may come down substantially more, but at least we start to build a base back up. Give me your comment.
My comment is, I guess, the question of who gets the benefit of the upside. And having taken the losses on the taxpayers, if we sell them at fire sale prices, then private investors will get the market when it comes up, and we will end up having larger obligations. It seems to me that the taxpayers ought to be able to make a sensible, staggered sale. And the other thing I'd say is not all those assets they hold are non-performing. In fact, the majority of them are performing assets.
Mr. Chairman, Ms. Mortel, I was only speaking to the non-performing portion of the portfolio. And being at foreclosure central, I don't know how you get the chicken and the egg. We're going to wait till it gets better to sell, but it never gets better to sell because I always have the anticipation of all these foreclosures that are in process that never go to the actual sale.
And with that,
Sorry, Mr. Chairman, does that mean I'm beyond my time?
just
Thank you.
Just a smidge, and I thank the gentleman.